The market has done something that looks simple on the surface and is dangerous to misunderstand. In a very short period of time, the S&P 500 and the Nasdaq have nearly completed a full V-shaped recovery. Bitcoin has also moved strongly, rising from the mid-$60,000 range toward $80,000 at the time this situation is being described. Most people look at that and say, "We are back." That is the first mistake when markets move quickly after fear. People usually confuse relief with resolution. They see green candles, rising index charts, and strong daily headlines, and they assume the underlying problem has disappeared. But in markets, one of the most important principles is that price and reality do not always move together at the same speed. Price often moves first. Reality catches up later. What has happened here is not that the world suddenly became safe. It is that the market took the extension of the US and Iran ceasefire, combined it with strong corporate earnings, mixed in continuing enthusiasm around artificial intelligence, and decided to buy risk again before the full outcome was known. That is how markets work. They are discounting machines, but they are also emotional machines. They do not wait for every fact to be settled. They move when probabilities shift. Right now, the probability of the worst case has been marked lower. That does not mean the worst case is gone. The situation in the Middle East remains fragile. The ceasefire is not permanent. Oil prices remain elevated because the risk around the Strait of Hormuz has not gone away. Additional drone activity and threats around us warships remind us that the conflict has not been fully settled. So when investors celebrate this rally as if the macro problem has been solved, I see something different. I see short-term relief. I see earnings strength, I see AI optimism, but I do not see a complete resolution of the underlying risk. That distinction matters because if you get it wrong, you either stay frozen while the market runs away from you, or you chase the market at the wrong moment because you think the danger has disappeared. Both reactions are emotional. Neither one is a system. In my experience, the biggest mistakes investors make come from reacting to headlines without understanding the machine underneath them. They watch a rally and assume risk is over. They watch a sell-off and assume opportunity is dead. They let each headline tell them who they are supposed to become that day. That is not investing. That is being pushed around by the environment. To understand what is really happening now, you have to step back and look at the basic cause and effect chain. First, the market sold off because war risk, oil risk, inflation risk, and interest rate risk all moved in the wrong direction at the same time. Then the market recovered because the worst case did not immediately happen. That is a very different thing from saying the risks were solved. A ceasefire extension can reduce fear. It cannot make oil structurally cheap. Strong earnings can support equities. They cannot remove geopolitical risk. AI momentum can keep capital flowing into technology. It cannot prevent inflation if energy prices remain high. This is why the current rally has to be understood as a probability adjustment, not a clean victory. Markets are always weighing what might happen next. When fear becomes too high, even a slightly less bad outcome can create a violent rally. That is why markets can recover when ordinary people still feel uncertain. Most people think markets rise because everything is good. That is not true. Markets often rise because the outcome is less bad than feared. That is a very different principle. If you understand that, you can stop being confused by a market that rallies while the world still looks unstable. The market is not saying there is no risk. It is saying the immediate probability of the worst case has been reduced. That is why the right response is not to panic sell. It is also not to blindly chase. The right response is to build a system that can survive both possibilities. There are two realities that have to be held in your mind at the same time. One reality is that a larger dip is still possible. Oil can stay high, inflation can move higher, the Federal Reserve can remain tight for longer, corporate earnings can slow, the Middle East can flare again, Bitcoin and risk assets can fall. The other reality is that waiting forever for the perfect crash can destroy your chance to participate in the greatest technological shift of our lifetime. That is the tension. And good investing is almost always about managing tensions rather than pretending one side does not exist. If you sit entirely in cash because you want a perfect 20% correction, you might be right for a while. But if the market does not give you that correction, you lose time, you lose positioning, you lose compounding, you lose participation if you go all in because the market recovered. You might be right for a while, but if oil spikes again, inflation rises and liquidity drains out of risk assets, you may be forced to sell at the exact wrong moment. The answer is not certainty. The answer is sizing. The answer is diversification. The answer is a disciplined process. That is why, for most people, the left curve and right curve answer is the same. Dollar cost average into the assets where you have the strongest long-term conviction, and keep enough cash reserves to buy more if a larger dip arrives. This sounds simple because the best principles often sound simple, but simple is not the same as easy. Most people cannot do it because their emotions interfere. They buy more when they feel safe. They buy less when prices are cheap, but the news looks terrible. They do the opposite of what a good system would tell them to do. History shows that markets spend far more time in expansion than in contraction. The S&P 500 has finished positive in roughly 7 out of 10 years over long periods. Bull markets tend to last longer than bear markets. Bear markets are intense, painful, and frightening, but they are not the normal state of the machine. That does not mean you ignore bear markets. It means you prepare for them without building your entire life around them. If you are in the wealth accumulation phase, sitting on the sideline forever is its own form of risk. People think cash is neutral. It is not. Cash is a decision. It is a bet that the opportunity cost of waiting will be lower than the benefit of entering later. Sometimes that is true, often it is not. And when the world is going through a major technological acceleration, the cost of being absent can be very high. That is why the current environment is so important. We are seeing multiple forces at once. The market is recovering, AI is accelerating, robotics is advancing, digital assets are rebuilding after fear. Governments and billionaires are openly discussing a future in which large portions of the population may not work the way earlier generations worked. That last point is more important than most people realize. When people like Elon Musk and Sam Altman talk about universal high income, universal basic income, or universal basic wealth, you do not have to agree with the policy to understand the signal. These are not random people making casual comments. These are people building the technologies that could radically alter the labor market. When the people building the machine are also talking about how society will pay people after the machine displaces labor, you should pay attention. That does not mean the future arrives tomorrow. It does not mean every job disappears. It does not mean the exact policy will be implemented the way it is described today. But it does mean that the direction is real enough that the people closest to it are already discussing the consequences. There are two ways to respond to that. You can do nothing and become a consumer inside someone else. Economy, you can rent from the people who own the systems. You can wait for checks from the government. You can hope that policymakers protect your standard of living. Or you can prepare, you can own pieces of the systems that may create the productivity. You can diversify your assets. You can own Bitcoin if it fits your framework. You can own gold if you understand why it may protect against monetary debasement. You can own growth companies. You can own international exposure. You can build a portfolio that gives you optionality rather than dependency. That is not about greed. It is about not being passive in a world that is changing quickly. I have learned over and over again that money does not solve every problem. It does not create meaning. It does not replace relationships. It does not make a person wise, but it does create options. It determines the neighborhood you can live in. It affects the school district your children can access. It affects whether a medical bill is a crisis or an inconvenience. It affects whether you can walk away from a bad job, a bad deal, or a bad situation. That is why building financial security matters. Not because money is the goal, but because money is one of the tools that reduces fragility. And right now, the world is giving people a very clear test. There is a generational wealth transfer taking place, not only between older and younger generations, but between people who understand the new systems and people who only consume them. Anthropic reaching enormous valuations, Apple going through major leadership change, Google, Microsoft, Meta, and other large companies committing hundreds of billions of dollars to AI infrastructure. These are not small stories. They are signs of a capital migration. Money is moving toward the systems that may define the next era. In moments like this, the crowd usually does one of two foolish things. Some people call everything a bubble and do nothing. Other people believe everything will go straight up and by without a plan. Both can be wrong in different ways. It reminds me of other moments when people saw the early signals of a major disruption and dismissed them because they did not want to change their mental model. During the early phases of a shock, most people think it will stay contained. They assume life will return to normal because their mind wants normal. Then the shock spreads, and by the time they respond, the people who prepared early already have the advantage. That is how humans behave. We underreact to slow-building change, then we overreact when the consequences arrive. The same thing is happening with AI. Some people say it is just a bubble. Some say it is not smart enough to affect their job. Some believe it will change everything. But they still do nothing because action is uncomfortable. The danger is not only being wrong, the danger is being asleep. There are winners and losers in every major transition. You may not like that, but disliking the game does not change the game. The goal is not to complain that the rules are unfair. The goal is to understand the rules well enough that you are not crushed by them. That is where a framework becomes essential. The biggest problem for modern investors is no longer lack of information. That used to be the problem. Wall Street had research, terminals, analysts, networks, and access that retail investors did not have. Today, the problem is different. There is too much information. AI can produce research. Social media floods you with opinions. Every headline is amplified. Every chart is presented as urgent. Every influencer claims to know the next move. The average person is not underinformed. The average person is overwhelmed. Information overload creates paralysis, and paralysis is expensive. So the important question is not what is every possible thing happening in the world. The important question is what are the few variables that actually move the needle. In this environment, there are 5. The first is the war and geopolitical risk around Iran. Markets are reacting to the probability of escalation or de-escalation. The worst case would be a wider conflict, ground involvement, or a prolonged blockage of critical oil routes. The more likely path, at least for now, appears to be a messy middle tensions continue. Negotiations drag on, isolated incidents flare. Both sides test each other, but the system avoids total rupture. That messy middle is still risky, but it is not the same as full escalation. Understanding the difference matters. The second variable is oil. Oil is one of the fastest ways geopolitical risk enters the real economy. If oil stays high, inflation pressure stays high, margins get squeezed, consumer spending gets pressured, the Federal Reserve has less room to ease, risk assets become more vulnerable. If oil cools, the system gets relief. That is why oil is not just an energy story, it is an inflation story, it is a liquidity story, it is a market story. The third variable is inflation and interest rates. If inflation stays elevated, the Federal Reserve cannot easily cut rates without risking a larger inflation problem. If the economy weakens and inflation falls, the Fed may have room to ease. Markets tend to price that possibility before it happens. So investors do not only react to actual rate cuts, they react to changes in the probability of future rate cuts. That is why a change in tone can move markets before a policy change occurs. The fourth variable is corporate earnings. Earnings are the fundamental cash flow of the equity machine. If companies continue to produce strong profits, the market has support even in a difficult macro environment. If earnings weaken, the rally becomes more fragile. This is why it is not enough to say the market is expensive or cheap. You have to ask what profits are doing and what investors are willing to pay for those profits. The fifth variable is AI optimism. Right now, the market still trades partly on whether investors believe the AI spending cycle remains intact. A single headline about a lower-cost model, a breakthrough from a competitor, or a major shift in compute economics can move enormous amounts of market value very quickly. We saw how easily fear around a new AI model could erase hundreds of billions of dollars in market capitalization from a leader like NVIDIA. That is how sensitive this theme is. But sensitivity does not mean the theme is fake. It means the theme is powerful and crowded. Powerful and crowded assets can make people rich, but they can also punish people who enter without a plan. Those 5 variables give you a way to filter the noise. When a headline appears, do not ask, "Is this scary?" Ask, "Does this change one of the 5 major variables? Does it change war escalation risk? Does it change oil? Does it change inflation or rate expectations? Does it change earnings? Does it change AI optimism?" If it does not change one of those, it may be noise. The world will always produce noise. Your job is not to react to every vibration. Your job is to identify the signals that change probabilities. Looking at the current setup through that lens, I see a market that is stronger than fear suggested, but still vulnerable. The war risk looks less severe than it did at the peak of panic, but not solved. Earnings remain supportive. AI remains a strong narrative, but oil is still elevated, and the Fed is not yet in a position to become aggressively easy. That creates a market that can grind higher if oil cools, inflation stays contained, and earnings remain strong. It also creates a market that can correct sharply if oil rises again, inflation accelerates, and the Fed stays constrained. That is why I do not believe the correct move is to become certain. The correct move is to be prepared for both paths. On a high time frame, I still believe markets will likely be higher in the future. That is not because I know the next month. I do not. No one does. It is because capitalism, productivity, technology, and monetary systems tend to push asset prices higher over long periods. But the path is not smooth. There will be corrections, there will be shocks, there will be moments when people believe everything is over. Those moments are usually where the best long-term opportunities appear. The challenge is that the best opportunities rarely feel good when they arrive. If you want to participate in asymmetric upside, you need a method for identifying it before the crowd fully prices it in. The highest upside opportunities often have several factors together. There is a strong narrative before it becomes obvious. There is a place where attention is likely to flow. There is liquidity that can enter. There is a chart or market structure that has not yet fully reflected the thesis. There is relative strength during fear. And there is an asset or company that gives concentrated exposure to the theme. That is the structure behind many large wins. It is not simply guessing. It is not buying random green candles. It is finding where narrative, liquidity, timing, and risk-reward intersect. In past cycles, people who understood this could identify opportunities before retail attention arrived. A new chain, a new decentralized exchange, a new infrastructure layer, a new route for liquidity. These things can create enormous moves when the market is still skeptical. But there is an important principle here. The same setup that creates huge upside can also create huge losses if you size it badly or refuse to sell when the thesis is mature. Buying is hard, selling is often harder. In crypto especially, people talk about entering early, but many who enter early still fail because they never define the exit. They watch a life-changing gain become a smaller gain and then a loss, because they confuse conviction with attachment. Conviction should make you act with clarity. It should not make you blind. In the current environment, I am not interested in chasing every new coin or every new stock. I am interested in building a watch list around the areas where attention may return fastest when risk appetite improves. That means looking at what held up better than expected during uncertainty. It means studying where capital flows even when headlines are negative. It means paying attention to assets that refuse to die when fear is high. Relative strength matters, not as a magic formula, as evidence of demand. When an asset stays firm during stress, it may be telling you that stronger hands are accumulating it. When a sector rallies while most people are distracted, it may be telling you that money is positioning before the story becomes obvious. But you still need discipline. You do not buy everything that is green. You build the list, you study the liquidity, you define the thesis, you define the invalidation, you decide the size before emotion arrives. Most of the year is not an ideal trading environment. Most of the year is choppy. The big money is often made in a relatively small number of windows when the higher time frame and lower time frame align, when liquidity returns, when risk appetite improves, and when your prepared list begins to move. If you are fishing, there are moments when the tide is right and almost every cast has a chance. There are other moments when you are just throwing into dead water. Markets are similar. Good traders and investors know when to be active and when to be patient. The mistake is believing you have to be doing something every day. You do not. Often the most valuable work is preparation. The market rewards the person who did the work before the window opened. That is why retail behavior can itself become a signal. When people stop watching, when views fall, when nobody cares about a theme that still has strong fundamentals that can be part of the opportunity, retail usually arrives late. It becomes most interested near the top and most absent near the bottom. The crowd does not do this because it is stupid. It does this because emotion is human. When prices are rising, people feel safe. When prices are falling, people feel pain. The investor has to invert that instinct. Now, when it comes to specific exposures in this kind of environment, there are several categories that fit the asymmetric framework described. In the source, the first is Bitcoin. Bitcoin remains the core digital asset for many investors who believe in long-term monetary scarcity and institutional adoption. The key is not to treat every price level the same. Above important support levels, the long-term thesis may remain intact. Lower zones can become better accumulation zones if the thesis is not broken. Extreme fear zones can be moments where more aggressive buyers act, but again, the system matters if you do not know what size is appropriate. Bitcoin can control your emotions. If you do not know what level invalidates your short-term trade, you are not investing. You are hoping for a long-term portfolio. Bitcoin can be a meaningful diversifier, but it should be sized according to volatility. It can rise quickly and fall quickly. The people who survive it are not the people who pretend volatility does not exist. They are the people who build around it. The second area is hyperliquid and the broader idea of crypto infrastructure that produces real usage and real fees. The important thing about a protocol like this, as described in the source, is not just that people are excited about the token. It is that the system is generating activity, perpetual volume, total value locked fees, earnings, buybacks, on-chain data. These are not just stories. They are numbers that can be tracked, that is useful. When a crypto asset has measurable usage, it becomes easier to separate narrative from reality. The thesis here is that Hyperliquid is moving beyond being a narrow crypto exchange and toward a broader financial infrastructure layer where traditional assets, commodities, equities, prediction markets, and crypto native markets can trade around the clock if that thesis is right. The upside can still be meaningful because the market may not fully appreciate the scope of what is being built, but there is also a risk validator. Decentralization matters. If a system is still centralized in important ways, that is a structural weakness. It may not matter in a bull market. It may matter greatly in a stress test. Serious investors do not ignore the bull case or the bear case. They hold both and size accordingly. The third kind of exposure is a public market wrapper connected to the same underlying theme. In the source, that role is filled by PER, a listed equity connected to hyperliquid treasury exposure. The reason this matters is that traditional market participants sometimes prefer equities over direct crypto assets. If risk appetite returns and traditional capital wants exposure to the theme, equity wrappers can attract flows. But a wrapper is not the same as the underlying asset. You have to understand its net asset value, its structure, its management, its capital access, and whether it trades at a premium or discount. If it is near its NAV, the easy discount may not be there. If liquidity returns, the premium can expand. If the theme weakens, the premium can disappear. These instruments can create leverage. Leverage cuts both ways. The fourth exposure is MicroStrategy, which is effectively a public equity vehicle for leveraged Bitcoin exposure. The thesis is simple. If Bitcoin rises meaningfully, MicroStrategy often amplifies the move because it holds a large treasury of Bitcoin and is treated by the market as a regulated equity proxy for the asset. That can be powerful during a Bitcoin bull cycle. But it also carries leverage and structure risk. It is not the same as owning Bitcoin directly. It can outperform in the right environment and hurt badly in the wrong environment. That is why, again, the question is not, can this go up? Many things can go up. The question is, do I understand what I own well enough to hold it through volatility and exit it when the thesis changes? The fifth area is higher risk meme and consumer crypto exposure, represented in the source by Pangu. This is the most speculative part of the framework. Meme assets are not valued like businesses. They are driven by attention, culture, liquidity, community, and timing. That does not mean they cannot make money. It means they must be treated as high-risk, high-volatility instruments. In every crypto cycle, some high-cap meme asset tends to capture retail attention. The question is not whether that can happen, it can. The question is whether you have a defined exposure and a defined plan, or whether you are simply buying a lottery ticket with borrowed conviction from someone else. If you treat a meme asset like a core asset, you are making a category error. If you size it as a speculative opportunity and understand the risk, that is a different thing. The sixth area is Ethereum, related treasury or public market exposure, represented in the source by BMR. The general idea is similar. Ethereum remains a core crypto ecosystem. It may lag at times, but it has survived multiple cycles. If risk appetite returns and Ethereum catches a broader bid, public market vehicles tied to that exposure can move quickly, especially when they have a recognizable spokesperson, a clear story, and enough capital to become part of the market narrative. But narrative is not enough. You have to study holdings, NAV, liquidity, financing, and incentives. When a vehicle becomes more story than substance, the risk rises. When the structure, capital, and narrative align, the opportunity can become interesting. The principle across all of these is the same. Do not buy because you are excited. Do not buy because someone on the internet is confident. Do not buy because you are afraid of being left behind. Buy only when you understand the thesis, the risks, the size, the time horizon, and the exit conditions. A market like this can create enormous opportunity, but it also punishes confusion. It punishes people who do not know whether they are investing, trading, speculating, or gambling. Each of those games has different rules. If you mix the rules, you eventually pay for it. If you are dollar cost averaging into a long-term asset, you do not panic because of daily volatility. If you are trading a high-risk token, you do not marry the thesis forever. If you are speculating on a meme asset, you do not pretend it is a productive business. If you are using a public equity wrapper, you do not ignore premium, discount, liquidity, and treasury structure. Good decisions begin with honest classification. That is one of the most important principles in investing and in life. Know what game you are playing right now. The world is entering a period where those who are grounded will have an advantage over those who are merely stimulated. The market will throw headlines at you. War, inflation, oil, AI, crypto, rate cuts, earnings, elections, regulations, liquidity. Every day there will be another reason to become emotional. You need something that keeps you steady. For some people, that is a written investment plan. For some people, it is a disciplined community. For some people, it is a set of principles. For some people, it is faith. Whatever it is, you need a grounding force because ungrounded people become reactive, and reactive people become exit liquidity for disciplined people. That is harsh, but it is true. When you are rooted, you can think. When you can think, you can assess probabilities. When you can assess probabilities, you can size risk. When you can size risk, you can survive volatility. When you can survive volatility, you can be present for the upside. That is the chain. The current market is not easy. It is not clean. It is not one-directional in the short run. It is full of contradictory signals. There is a rally, but there is also risk. There is AI optimism, but there is also valuation pressure. There is crypto opportunity, but there is also volatility. There is geopolitical relief, but there is no final settlement. There is liquidity returning, but there is no guarantee it stays. So the correct mental model is not certainty. It is preparation. Prepare for a pullback. Prepare for a continuation. Prepare for volatility. Prepare for opportunity. Build a core. Hold reserves. Study the asymmetric plays. Define your rules. Do the work before the crowd comes back. Because when the window opens, it rarely opens politely. It opens suddenly. Prices move before people feel ready. The prepared investor acts. The unprepared investor watches, hesitates, chases, panics, and repeats the cycle. That is why the real last chance is not one coin, one stock, one ETF, or one market call. The real last chance is to stop being passive in a world where the systems are changing faster than most people can process. If AI truly becomes the dominant productivity engine, you want to own parts of that engine. If digital assets become a larger part of the financial system, you want to understand which parts have real usage and which are only noise. If inflation and debt continue to reshape purchasing power, you want assets that protect you from silent erosion. If markets correct, you want cash reserves and conviction. If markets continue higher, you want exposure. That is the balance, that is the system, and that is how you avoid being controlled by each new headline. The market may go higher from here, it may correct again. First, I do not know the next move, and neither does anyone else with certainty. But I do know this, people who wait for perfect clarity usually get the worst prices. People who act without any system usually get destroyed by volatility. People who prepare, size correctly, diversify, and keep learning give themselves the best probability of being on the right side of the next major wealth shift. That is the point, not to predict every wave, to build a vessel that can cross the ocean.